Hi, Jim Yent from Golden Years Advisors, the home of the Kairos Formula. We hope you've had a great 4th of July. I know Teresa and our grandson and I enjoyed it, sipping a cold one, getting a little wet. Hope you had a wonderful time with loved ones. But to the matter at hand, we want to do 3 things in this video update. We want to do a first half recap, what's gone on, talk about what's happening within the strategies, and then say where do we go from here. So let's jump into it and let's let the slides do some of the talking. So on the first slide, the best way I can sum it up is that title line. Historically, we've had one of the worst first year, half year starts in many areas of the market. From a CPI or inflation perspective, we've had the highest inflation numbers since 1981. Then in the charts below, you see some of the large major market indices. The S&P 500, it's been the worst start since 1970 for the NASDAQ. It's the worst first half year start in its history. And similarly for the Barclays US Aggregate Bond, that's the worst first half in their history too. And more interestingly, if you look at the chart, and red is the S&P, real quick, green is the NASDAQ, and blue is the Barclays Bond. January we had a slide of about 10%, and we had a series of what are known as bear rallies. So you'll see either 5 to 10% upswings, and then the index will then slide further down, and we might have another 5 or 10% rally, a bear rally. Some people call it a bull trap, and will fall again. And our current low, the low that we've had thus far, was in mid-June, and since then we've had another about 5% rally since that point. So from a starting perspective, horrible, just rough for any investor to have. So when I look at how the market has done, I think we're in a 3-act, I hope it's a 3-act play, not a 4-act play. And the way the market evolved is Act 1 was all about inflation going very high, and the Federal Reserve then pivoted and started getting very aggressive in their rates. So on this next slide, what we can see is on the inflation front, the darker red line is CPI, Consumer Price Index of Inflation, and it still has not peaked yet. The last month report we have is May, where the headline inflation is at 8.6, the worst since 1981. That second lighter red line, you see it's at least started to turn downward a bit, which is hopeful for us. But that's core inflation, which is if we take out food and energy. Now it's hard to do that, right? We all need food and energy to live, but at least that appears that maybe we're seeing a peak happen there. If we move on to the next slide, the Fed focuses instead on the PCE, the Personal Consumption Expenses Deflator, the PCE for short. And I've highlighted it down towards the bottom of the page. The good news is that since March, the headline number already hit its peak. We hope it remains that way at 6.6% in the last running 12-month time period, and has since started to at least tick down and stabilize. And more importantly, once again, the Fed thinks they really can't control food and energy. And they're right, they can't. And so that has gone even lower, down to 4.9. So we're glad to see, at least on the PCE front, it's peaked, and let's hope it continues to drop down lower. Now, why this is important is because the Fed has already raised the federal overnight rate to 1.65. And we're in July now. They plan to raise it another 0.75%. So we'll get right around the 2.5% mark. That 2.5% mark is neutral, the neutral rate, where they're not hurting the economy. They think that the economy can handle that. They're planning and announcing to go beyond that to what they would call the restrictive rates, where it would start slowing the economy down. And the economy is already slowing. So that is really one of the big concerns as we go forward. Is the Fed going to move too high? So that's Act 1. Act 2 is, well, what's the consequences of these higher rates? Well, the consequences are that the economy is going to slow down if the Fed keeps aggressively growing things. So let's look at this next chart, which says, where are we heading? And we've shared this before. It's from our buddies at City National Rockdale. And you see this green line showing that, and there's a blue bubble of the US where we are here. Our economy is decelerating. It is slowing down. And we said going forward, there could be several paths. And we kind of put odds on them. And one of them was we'd have normal growth, which is seeming less and less possible. But we, in our last discussion with y'all, said, we're looking between the slow growth scenario, which is a 30% odds based on City National Rockdale. But what's becoming more and more probable is that next line down, a mild recession. And of course, it could get even deeper into a full recession. And so as the economy continues to slow, this is Act 2 of our play, there's more concern that GDP is going to get negative. Therefore, profits are going to shrink for stocks. And as a result, the earnings per share will be less and you'll see markets fall. So this is where we're kind of at right now in this recession scare, and we're at least slowing down very dramatically. If you were to look right now on certain indicators, it already shows us kind of being slightly negative now, and we're just exiting the second quarter. If that were to continue, we would go into either that mild recession or something worse strategy. So that's Act 2 on all the concerns. That's why the market right now is struggling, let's use the S&P, to even get back up to some of the earlier numbers it easily had during the year. Just as a quick data point, at the beginning of the year, we hit our new high in the first 3 days of the year. We went almost to 4,800 on the S&P. Right now, we're struggling just to be in the 3,800s to 3,900s. And there's a reason for that. When you relook at the metrics of whether the market's priced right now, the proper price is somewhere around plus or minus 4,000, with rates continuing to go higher and the potential of profits to shrink. So we're not going to resolve this and spring back quickly like we did during the COVID bear market, because we had to wait for COVID to disappear. In this situation, we have to wait for inflation to slow down and for the Fed to quit being aggressive. That's what we're waiting for. So from a strategy perspective, what's going on? Well, as we've said before, in January there was a 10% drop, and we didn't, either in the third-party strategies and in our golden year strategies, we didn't really do that much. But from February, March, April, May, all of those strategies did a lot of positioning and actually outperformed, meaning they lost less in the market and often would gain in a month rather than have losses in the market. By the time we hit June, all bets were off. June was a big downdraft of over 10%, and there literally was no place to hide. It didn't matter, bonds, even oil and commodities fell during that month. Specifically in the strategies as we speak, the Sherman, just to give you some examples, the Sherman strategy as we speak is 60% cash, 10% bonds, only 30% is equity. Just using port formulas as an example, 35% of it is in cash as we sit trying to be defensive. If I jump to some of the golden years GYA strategies on the global growth front side, we're 50% completely defensive, not in cash, but in dollar, things just trying to earn a little bit. Similarly on things like low volatility stocks. So all of these equity positions are in a defensive mode, waiting till something abates. Now, we're seeing some lifts, so we're hoping still to get some lifts during that time period, but we're more concerned about the downdrafts at this moment. So let's move to the final piece. What's our go forward outlook? Or as every investor asks, when does this end? Well, we are in a bottoming process, but we can't say whether we've hit the last bottom. And that's whether this is the 3 acts. So the third act would be recovery. We'd start seeing the markets to recover. There is the potential, as we said, that it could get worse. The worst is a deeper recession or something stresses the market so that it breaks. But those are low odds as we sit. So we're hoping it's a 3-act play and that recovery is on the way. Now the question is the recovery soon, like say before the election, or is the recovery a post-midterm election? I want to just point you at 1 or 2 data points which give us optimism. We got so washed out in mid-June that only 2% of the S&P companies were above their 50-day moving average. That's a very, very negative situation. It's only happened 4 times in the history of the S&P 500. And on this chart, you'll see them. And whenever we've blown out that badly, once was in the tech bubble, once was in the mortgage meltdown, once was more recently 2018, the fourth quarter scare, and then the fourth one was during COVID, but this is the 5th time it's now happened. It's not so much at the 1 week or the 2 week, but once you get 1 month, 3 months, 6 months further down the pipe, you see the beginning of that recovery take place. Not just a bear rally, but something that lasts. 3 out of 4 of these past historical events had some pretty strong numbers, 6 months and beyond. We hope we're in one of those camps. The one that didn't was the mortgage meltdown. And during that time period, they never resolved the problem. We know what this problem is. It's very straightforward. It's whenever inflation starts to slow down so that the Fed backs off the brakes. So going forward, final slide, what are we monitoring? Well, for the summer, we're focused on inflation. Has it really peaked? Is it drifting downward? Next week, we start the earnings season. Second quarter earnings, they're going to start being revised down. They haven't yet, but they have to. There's too much slowdown going on. We also want to hear what the companies say from a forward outlook called forward guidance. Thus far, it's been kind of mixed, but we're going to expect to see some negative things coming. By the end of this month, in the end of July, second quarter GDP, we'll see our first glance at it. We hope it's not a surprise like first quarter, but first quarter was negative, and we definitely slowed down in the second quarter. By the time we hit September, the question is the Fed backing off or still hitting the brakes? So the best comment I can tell you is we are in a bottoming process. We're cautiously optimistic that the Fed will solve, inflation will abate because the economy itself is slowing. That will cure the inflation, but it's how aggressive the Fed remains, which will determine when we start recovering. And that recovery process, whenever it begins, is a multi-quarter recovery process. So the sooner it starts, the sooner we can get back to some market highs. But just to be a realistic person, I don't believe we're going to hit our market highs again this year. It'll be something in the next year time frame. So the recovery will begin. We'll see how long it takes to get back to it. That's the update from our side. If you have any questions, we'd love to talk with y'all. We'd love to do any kind of positioning you want. If you like some more details about bear markets, we have several documents. We can share that with you too. In the meantime, stay safe. Take care.